Well, thank you, thank you. And as opposed to last time, I think investing and saving is a little bit fun, a little bit more fun for us than tax concepts. But consider that, you know, death and taxes, those are the things we can't control. You might want to say to some of the items that we're going to be talking about today, well, Nancy, that stuff my accountant needs to know. And that is true. This is going to be material that your accountant needs to know. But if you go to your tax preparer with data, all he can do is interact with that data. He can't go back in the year, during the year, and perform these certain things for you that you need to have done ahead of time. By the time you go to do your tax return, I'm just going to say this one thing off the script. By the time you go to do your tax return, it's normally too late to change your behavior for last tax season. So it's really a positive attribute on your part to get ahead of it and get your materials together before you get there. And Ms. Anna, can I have a screen sharing capability? And when she gives me the screen, we'll be all good to go. Okay, so again, as Hannah mentioned, I'm Nancy Roach. I'm with Prudential. I'm a CFP, and I've been in practice for over 30 years. We work all over Chicagoland, and I have clients in about 8 states. So what's important today, taking control of your taxes. We're going to get ahead of and not get behind the 8 ball. On December 27th, 2017, Congress passed the Tax Cut and Jobs Act, or TCJA, which was actually one of the most significant pieces of tax legislation that we have had in over 30 years. During today's session, we're going to cover some of the changes that were made at a very high level, as well as discuss some tips for tax-efficient investing. But before I do that, I want to remind everyone that I am not a tax advisor. I am a CFP, but I am not a CPA. So your ultimate decisions about whether or not a behavior will help or hurt your taxes should be discussed with your tax specialist. Now, we're going to jump right in there. One of the biggest changes that was made for the 2020 through 2025 tax returns was this. We have gone to 7 income brackets. And the brackets on the left side are for individual taxpayers. The brackets on the right side are married filing jointly. Now, the first 3 brackets have been widened so that you and I can earn more income and pay less tax. The last 2 brackets have been shrunk a little bit. So at the highest income levels, there are some more taxes involved, and the second 2 just weren't basically changed. So I'll just give us one example. So most of us as an individual between 40,000 and 86,000 in income, we will come in at the 22% tax bracket if we're an individual, all the way up to 86,000. If we're married, the 22% bracket will take us all the way up to 172,000. Now, what that means is that your taxes are going to be based on your joint income. In the past, that could have been as high as 40, 45%. This is a big difference. Another nice difference on a joint return, if your after deductions income is only $80,000, you are only going to be paying at the 12% marginal rate. Another area that has impacted tax returns, which you may or may not have had happen with you, is with the estate, gift, and generation skipping tax. Now, just during the period of TCAI, which expires in 2025, that was a compromise that had to be made to get this act through Congress. So the families could have, before the Tax Act, $8.5 million before any estate taxes are due. That number has gone up to 22 million, which means most of us, when we pass, our estate will not be subject to an estate tax. Now, a lot of clients ask us, well, I'm never going to have, 100 million or 20 million or 10 million, but you'd be surprised that things add up, because the definition of estate is everything that's in your name on the day that you pass. So you can have estate taxes on items that even have a mortgage. So if your house is worth $6 million or $3 million, whether it has a mortgage or not, the estate tax will be looking at the total value of your house. So that's the total value of all of your assets, your house, your stocks and bonds, your cars, jewelry collections, and even in some cases, your life insurance. So you have to be somewhat careful and somewhat mindful that you don't want to pass with very high volumes of money in your name. One nice thing was no changes were made to the capital gains or net income tax rates. The long-term capital gains rates are either 0, 15, or 20. Now, in the past, that has been as much as 40. So what a long-term capital gains are items, a stock or a bond, or even any other type of thing that you did for business that you hold for at least 12 months. So typically, you're going to have a more favorable tax treatment if you own something and hold it for at least 12 months. We're going to talk about that more with a real example. This third point here, the net investment income tax. This is part of the ACAA or Obamacare. What happened during the ACAA is that they decided that they would, excuse my little marks there, this 3.8% surtax is for people who have income.
Hey, Nancy, can you hear me? I think she may have frozen. Let me see. Okay, so it looks like we may have, oh wait, what's happening? Hold on. Sorry about this, everyone. Give me 1 second. Let's see. Okay, so we got word she's working on getting her computer back up and running. Just give us one moment. All right, I think she's coming back.
Okay, I hope I'm back now.
Yes. Did you want your video on?
Yes, please.
Okay, there we go.
Sorry about that, technical difficulties, and I will just continue from here. So this last item on this slide talks about an extra tax that's for people who make a very high income and also have investment income. And if that is the case, then they
Nancy, it looks like you're on mute.
I have unmuted twice, and I apologize. And do you show me up on one screen or two? Sorry, gang.
I see you on one screen. It doesn't look like you're sharing your screen anymore.
Okay, so we got my voice back, but I'm not sharing the screen. So, no, why does this happen? It's not that one. Please stand by. And share screen and sorry, let me. Can you see my screen?
Not yet.
Oh. Well, it's hard to talk about taxes. It's very dry without being able to see the screen, but I will do my utmost here. Let me try one other share screen and screen desktop share.
There we go.
Oh, that. All right. Please forgive me, gang. Okay. So that last item, so the main thing about the TCAJ that you need to know is that some deductions were retained and some deductions were repealed. And with that, basically the entire package is designed to get you to the lowest possible adjustable gross income, which is that number on the front page of your tax return that you're going to ultimately be taxed on. There were no changes to net income tax. So the TCIA, for example, the student loan deduction was maintained, and it was retained at $2,500 with certain income phase-out limitations. The $250 out of pocket, if you're a teacher, you also get an automatic an expense deduction for $250 worth of supplies. On the other hand, if you're paying alimony and your alimony deduction was completely repealed in 2018, so that any divorce or separation, the deduction for alimony payments does not apply now. That does come back in 2026. That's a consideration. The standard deduction as a trade-off for eliminating some of the deductions, the standard deduction for everyone is now $12,550. This is important because what it means is you don't have to chase around saving receipts for all kinds of things, because you probably won't have, if you don't have more than $12,550 in deductions, you don't need to do that. If you're a single person and have a child in the house, you get the head of household deduction, or $18,800. And it's actually $25,100 for married couples filing jointly. And if you happen to try to file separately as a married couple, you still only get $12,550 each. So there's no real benefit for trying to be married and file separately there. The itemized deductions and credits. Now, these, again, what we're trying to do is take the second 2 pages of the tax return and have things, certain behaviors that you have that will impact the bottom line on the first page. So mortgage interest deduction has always been, it's been very traditional value that in the USA that, you know, that home ownership is valued. So there's been a mortgage interest deduction. Under the TCAJ, there was somewhat of a compromise, and only home loan interest up to $750,000 for the next 5 years anyways is deductible. New mortgages then would be capped at $750 for the purpose of the interest deduction, not meaning that you can't get a mortgage over $750, but you can't deduct interest over $750, only the interest that applies to a mortgage under $750. The $750,000 cap expires in December of 2025 and goes back to $1 million unless Congress takes some type of action to prevent that from happening. Now, the deduction for interest on home equity lines, or HOAs, and if you have a banker, your banker often would talk to you, please get a home equity line of credit set up, have it there for emergencies. That deduction, if it's not for an improvement to your home, that deduction is eliminated. But for most of you, the good news is that deduction comes back in 2026, and that's probably about the time that you're going to start looking at purchasing a home. So state and local tax deductions remain in place, but they're capped at $10,000. Now this is interesting because you have to add all of these numbers up if you consider your mortgage interest, your state tax, and your local tax and your property tax. That might come out to $25,000 or $30,000. You can only deduct $10,000 of it today on your federal return. So even if your state tax, you lived in a nice neighborhood and your property taxes are $15,000, and combined with everything else, you can only deduct 10. So that was one of the changes for the TCAI. Now, interestingly enough, the health care mandate was repealed, and there's been a lot of discussion about this, the political environment. And what we see is that the entire country, there's a federal penalty for not having health insurance has been repealed. But there are 4 states, District of Columbia, New Jersey, Rhode Island, and California, where you will get a penalty on your state return if you don't have health insurance. Oregon and Minnesota are considering a penalty for that. We will be watching very carefully. This political environment is different. The current administration was involved in setting up Obamacare. I would not be surprised to see that penalty come back. I'm going to step back to here for just a minute. The charitable donations, if many of you have been, if you have churches or non-for-profit organizations that you contribute to, in the past you could deduct 50% of a cash contribution to your organization. Today, for the next 5 years, it's 60%. So if you donated $500, it was $250, but now it's $300 that you can actually deduct from your income. Effective January 1st, 2019, you can also deduct the amount of your unreimbursable medical expenses over $10,000. So you do want to keep track of your medical expenses. Miscellaneous itemized deductions there is a part of your tax return There used to be all kinds of, and on a tax return, it would show what was deductible there. And you had to get 2% of your AGI, and then any of those deductions, if it added up to more than that, you could take a deduction. That, because they raised the standard deduction on every individual from $8,000 to this $12,500, they took away this miscellaneous deduction. I think their goal was at the time to get the tax return as short as possible. Another thing they did, though, to the positive was that they doubled the child tax credit. So the tax credit for having a child in the house was formerly $1,000. It is now $2,000. The bill also includes a temporary extra $500 non-refundable credit for other qualifying dependents. You might have someone in your household who's disabled, but they're not under 18. So you don't get $2,000 for that person, but you would get $500. $500 deduction for people that live with you that are potentially disabled or elderly, and you get a credit for that. So back to the states, it's going to be very interesting to see what the federal government does on that front. Another item that's on your taxes, and you don't notice it until you start getting a real job, you have a real job and get real pay. So you remember when you signed up for the position and they told you that you were going to earn $50,000 a year, which comes out to, or let's say $60,000 a year, which comes out to $5,000 a month. And you're thinking, well, that first biweekly check is going to be $2,500. And the check comes in and, aha, it's not $2,500. Who is this FICA and where do I go to get my money back? Well, in reality, there are two deductions from your payroll, pre-tax, pre-everything that you don't have any control over. One of them is for Social Security, OASDI. It's currently at 6.2%. The portion that your employer pays is also 6.2%. If you're a solo practitioner and if you end up like dentist, a type of doctor in a practice by yourself, you're going to have to pay both the individual rate of 6.2% and the employer rate of 6.2%. So that's over 12% right off the top. You thought you were going to get a check for $2,500. Let's take off the first 12% for Social Security. Let's take off the second 1.45% for Medicare. And certainly certain people with ultra high incomes above 200 or 250 would get 2.35% taken off of Medicare. This is written in the law. It's on the payroll. You do not have any control over these two numbers while you're employed, while you're working. So we need to look for opportunities for you to have more money in your paycheck and to have a lower amount that you have to write at the end of the year in April. One of those opportunities is a 0% long-term capital gains rate. Now, it's a very interesting thing. First of all, to have a capital gains rate, you have to own something that grows. So now you're looking at owning a stock, a bond, a business. My son owns Pokemon cards and they have tripled in value. So he's going to have some capital gains. And a long-term capital gains rate means whatever it was that you owned it for at least 12 months. So what happens is if you're married and filing jointly and after deductions, your income is $80,000, which is a lot of people, you can have a capital gain and not have to pay any taxes on it. That's pretty cool. If you're single and you earn $40,000, you can have a capital gain and not pay any taxes on it. So let's, this is really helpful to see an example of how this works. So we have the Smiths here. They're 65 years old. Their income together between Social Security and a small pension, they're getting $60,000. Because they're a married couple, the standard deduction without having to save receipts or anything, $27,400. They're also 65. You get an extra couple of dollars to deduct for that. So their $60,000 income is really, after the standard deduction, only $32,600. They could in order to supplement their income. They could have things that they own that they sell and not be taxed up to $47,399. So that is a significant thing to know, that if you have stocks and bonds and other things like that, that if your income isn't too high, that you can liquidate those things at the present time at a 0% tax, as long as your personal income is not too high. And I hope I get questions about that. This next chart I really like because it shows us, highlights some of the different ways you can be taxed based on what it is, the type of product that you own. So in the upper left corner, the tax now items are mutual funds. They pay dividends, those are taxable now. If I sell them too soon, they're taxable now. Stocks and CDs. You have a CD at the bank and it pays interest throughout the year, you're going to get a 1099. The things that are taxed now go on your 1099 this year. That's what tax now means. Tax later are things that you will make a deposit of some type of savings. Or let's say you bought a farm, or you bought a business, and you're not going to sell it now. You're going to sell it way out there at some point in the future. Tax later also includes IRAs, 401ks, and annuities. So when the time comes, and in some cases it's required, that you make a distribution, then it will be taxed out there in the future, and it will be taxed as ordinary income. Now, the third category, the biggest category, you can tell we like that one the most, is tax advantage. Means that under the right circumstances, if you own these products, you can take your money back tax-free. And in my mind, tax-free is always better than taxable, but it's best always in investing to have a balance. So tax advantage, what are those? There are Roth IRAs, there are Roth 401ks, there are municipal bonds. Municipal bonds are like the Chicago Bears bonds, public schools, different limited state agencies that have to raise money and they make loans to the public. That interest is not taxed because it would really be like double taxation. And cash value inside life insurance policies. So if you have a life policy and there's cash growing in it, as long as you don't kill the policy when you take money out, if you leave some money in there to keep it growing, then that is tax-free to you as long as the policy is still in force when you pass. And I hope I get a question about that one. So we have at least 3 different types of products. Some of them are taxed today, some of them are taxed in the future, and some of them are taxed never, I say. If you do it right, you can have some products that are taxed never. So if you work for an employer that has a 401k, you want to ask them whether or not they have a Roth option available. Sometimes they call it the after-tax deposit. The after-tax deposit in a 401k will grow tax-deferred the same way that a regular 401k grows. The magic of computers, they just keep that value separate so that when you leave there, they will write you a check for a Roth IRA rollover. That keeping the tax status is very, very important because it went in after tax, you want it to stay tax-free. So the benefits of a Roth 401k, if you work for an employer and put some of your money, consider some of your money to going towards the Roth side of the 401k, I myself do 50-50. You have the increased tax advantages as long as you have a nice time horizon. It is a hedge against rising taxes because in one of the 2 items that I left for you there today, of training items, you will see that taxes have in the past been much, much higher than they are today. So we want the Roth 401k withdrawals are all made tax-free in the future, which means you're taking IRA money, you're taking investment money, you're taking a pension. But if you need a new roof or you need a new car, you need some more money that won't bump you into the next tax bracket, you can use this Roth IRA account. You can use your income from municipal bonds, and you can use loans from life insurance policies, all tax-free. So those extra items give you estate planning benefits. and they also give you tax diversification. Now, if you were to own mutual funds, and these mutual funds were not inside an IRA, then you might just be aware that mutual funds can send you current 1099s if certain thing happens. So the mutual funds buy and sell throughout the year, and if they buy and sell throughout the year for a net gain, they're not going to pay your taxes for you. So they'll send you a net 1099 and pass the taxes on through to you. It may occur and actually I have a step back. Mutual funds is the way that most Americans participate in the markets. Most Americans do not own individual stock. 4 times as many people own mutual funds as own any individual stocks. So a mutual fund is an organization where excuse me. In a mutual fund, they put your money together with other investors' money and make the selections that they're going to make. Theoretically, that lowers your overall risk. Every mutual fund has a prospectus. Every prospectus will tell you what that manager is going out to buy. If there's a mutual fund that buys only municipal bonds, then the distributions on that program, most of which will be tax-free. So you can buy a municipal bond for $50,000, or you can buy a municipal bond mutual fund for $1,000, and it includes a smaller part of a lot of different bonds, and the income on those are generally tax-free. I got to be careful about what I'm touching here. So the tax-free, in my mind, is always better than tax-deferred, but tax deferral has advantages as well. This person was fortunate enough to have a large chunk of funds that they invested, $250,000 in a tax-deferred account, like an IRA rollover. If they had taken the IRA distribution at the beginning and just invested the money, over time it would grow, but they'd be paid taxes on it each year. So the tax-deferred account takes advantage over the tax account in about year 7.5. You can see there's a wide difference. The longer you hold it, the bigger the difference. And if you were to take this $250 in a tax-deferred account and turn around and start spending it out in the future, you would have in a tax-deferred account, the more time you have, in this particular example, it's a very long time, but it's a long time, there's $141,000 more in the tax-deferred account to spend than there is if you were to put it in a non-tax deferred account and pay the taxes as you go. Because in the blue bar there, you don't have to pay taxes as you go. You're not interrupting. You're earning money on the money that you're earning. And so tax deferral has some significant advantages. All right, a couple other quick things we're going to cover, and we're rounding the corner, and I'm really looking forward to your questions. So one of the most important concepts in investing is diversification, being diversified. There's another concept that goes along with that. So even though at the beginning of the year, I might take my portfolio and invest it in 3 different things of equal amounts. By the end of the year, one of those items might have grown more, and one of those items, kind of lagged behind. And at some point, you're going to want to do what we call rebalancing and adjust this thing back to the original allocation. That's what kind of smoothing the road. Based on the performance, we buy low, sell high. So the one that went up, we'd probably sell some of and reallocate to the portfolio that did not do as well. Well, that is potentially a taxable event. Considering someone with 3 equally weighted investments, if they had $500,000 at the beginning of the year and $550,000 at the end of the year, when they go to do a reallocation, they have potentially added a $19,000 taxable event. We tell you this, it's a good thing to make money in the markets, We tell you this to just be aware that every time you make a sale transaction, you should talk to your advisor about just making sure that if we don't wait a few more days, can we get into the 1 year time period, or is it a must? It's not only the tax consideration when you're making a buy or a sell, but it's a consideration. And before you sell anything, you should take a look at it, whether holding it for a short amount of time, you might be able to better your situation. So the next concept, alternative minimum tax, does not apply to a lot of people, but it applies to some. And what the alternative minimum tax is, it's a way for the government will take a single filer earning more than $73,000 or a married couple over $114,000, and they have their own formula that they will run that income through, and they have got the traditional way to file it and an alternative minimum tax way to file it, and whichever formula comes out with a higher tax owed is the one that the taxpayer becomes responsible for. So people that have had the alternative minimum tax happen to them say, my gosh, I had deductions, I had this, I had that. Well, they're not going to let you completely off the hook. They want to make sure you pay your fair share of taxes. So people in this income bracket do have to pay what's called an alternative minimum tax. If you want more information on the AMT, you can go to NerdWallet, and you can also go to the www.irs.gov, and they'll give you some more information about that. I can tell you it is, finding out about the AMT is usually a surprise, so it's something that you want to know ahead of time. Interestingly enough, no one gets out of having a tax rate. So even your children, if they have unearned income, let's say that you put some mutual funds in their name or something, which used to happen a lot more than happens now. Before the kiddie tax, a lot of people thought that putting money in their minor children's names was a good way of getting out of taxes. And eventually the government caught up to that. So from, interestingly enough, if you look at this 12,700 number, children earning $12,700 per year pay the highest potential tax bracket. They pay more than someone who earns over $300,000 a year. They pay a higher rate of tax. So the kiddie tax works like this, up to age, for children up to age 19. Over 19, they go to the individual taxpayer rate. So from the first $1,100, they pay no tax. On the second $1,100, they pay this 10% tax. As they go over at $2,600 to $9,300, they pay 24% marginally. As they get to $9,300 to $12,500, they could be as much as 35. If they earn more, it could be 37. I think these numbers are a surprise to most people. And this is another one that if we were to go through the halls of the college over there and ask people what they thought the 401k limit was, I think most people would say 15, and because that's what it was for so long. But about 10 years ago, it started going up. So this is important, and it's good to know. The 401k, 403b, and 457 limit is you can defer up to 19.5 of your own income. Now, there's often an employer match to that, so it's to your advantage to do so. And that 19.5 includes regular contributions and Roth contributions. You may or may not know that people over 50 are eligible for a catch-up check, and that could be as much as $6,500. And it can be done on payroll. It can also be done at any time throughout the year. You can just write your 401k sponsor a check and saying, you know, I'm 51 years old, this is my catch-up check, I want this in my 401k. They can take that by check. It does not have to come off the payroll. People who sponsor simple IRAs, not too many anymore, but they can defer up to 13.5 with an extra $3,000 for a catch-up. If you were to do a SEP IRA, might have some advantages over a 401k, certainly less administration. But if you were to do a SEP IRA, there's no catch up because the initial contribution amount is so high. So on a SEP IRA, you can actually do 20% of your income plus $19,000 up to 57,000. Sorry, 25% of your income up to 57,000. So for a SEP IRA, there's no catch up. You can do up to $57,000 of income. And then an individual 401k is also interesting. If you are a solo practitioner, you can set up a 401k on just yourself. And that's fairly new in the last 5 or so years. 20% of that self-employment income can go there, plus 19,000 up to 57,000. And then you have what more people are commonly introduced to at tax time, which is these individual IRAs. Your accountant will say, hey, you know what, here's your tax picture, but if you throw a couple of $1,000s in an IRA, I can get you a few $100s off of that. People often consider it. We see a lot of them going in March and April. They are currently $6,000 for everyone and an extra $1,000 if you are the appropriate age. The last little bit, which I think is probably important for you guys, and that is the college, managing college expenses. And there's different ways to save for college. Again, you could put it in the child's name and then you're just watching it go, and then you've got kiddie tax and these other things to deal with. But these deferred accounts, you don't have to deal with the kiddie tax and the potentially ongoing tax returns. So the Coverdell Education Savings Account came out many moons ago. They must have forgotten about it because they never raised the limit. It's only $2,000 per child per year. You have to watch out for family members potentially contributing because it's $2,000 per child. And if 4 grandparents each put in $2,000, you'd be $6,000 over the limit. So watch out about that one. The 529 College Savings Plan is very common, and it's a great way to save on both federal and state taxes. Now, why do we put money in the 529? Well, the first benefit is that depending on your state, and Illinois is a yes, up to $20,000 contributed per year will be deductible on the state return for a couple. So that's a huge advantage right there. The other advantage is in both of these cases, when you go to spend the funds, when it's spent for college, it's tax-free. So talk about tax deferral. You got tax deferral, like in that other example, but it's also tax-free when you spend it for college. So I do have the pleasure of seeing clients go full circle on this. I had a client drop $75,000 into an education account when their daughter was 10, and it put her through 5 years of school, including a couple of years at Loyola. So it ends up that the tax deferral combined with the tax-free status for college really helps multiply that money. The other thing we want to talk about quickly in regards to college is that there are tax credits for students, the American Opportunity Tax Credit, and it makes the credit available for a broader range of people. You can claim up to $2,500 of eligible expenses on that one. And the deductions are for you can deduct up to $2,500 of student loan interest. So I know that being medical related students, that student loan interest is probably an important consideration. Okay, we have come to this taxes. There's a lot going on, a lot of moving parts. Do we need a professional to help us with our taxes? Maybe, probably, maybe at least the first couple of years that you do a tax return so that you can identify those areas where your behaviors at home will help improve the tax return, certainly help improve the tax return for next time. So going back to these college accounts, as long as you stay in these deferred umbrellas, and they're kind of like IRAs, where you're not spending the money, you're not declaring the money, it doesn't show up. So those could roll forward for years and years and years without ever showing up on your tax return. With that, I know this is a lot of technical stuff, and I'm sorry about the glitch in the middle. I'd love to entertain your questions now.